Hello viewers and good evening. Once again with one more video session on a lecture series from Global Associates. Today I'm planning to pick IAS 16 Revaluation of Assets. How the revaluation of assets has been discussed in IAS 16. That's the discussion topic I'm planning to take up for this particular video. So IAS 16, the matters relating to revaluation of assets. Now, prior to revaluation of assets, we have to understand that these tangible non-current assets, or in other words, property, plant, and equipment, could be classified as to depreciable assets as well non-depreciable assets. The meaning of these two terms are when an asset has a limited life, maybe 5 years, maybe 50 years, those assets are known as depreciable assets. Whereas any assets which has unlimited life, those assets are referred to be non-depreciable assets. Example I would write here is the land. Well, one, I guess, in my understanding, one of the main non-depreciable asset is land. Actually, these lands are free land. What I mean free land are that has not having any natural resources, which is extractable mineral resources, then that could have limited life. But the other lands which doesn't have such a mineral resources are here. Those lands are non-depreciable assets. Whereas depreciable assets are all other example you could bring: building, furniture, plant, equipment, and so on. So those assets are some examples for depreciable assets. Now, from prior to thinking about the revaluation, when these assets are being under usage, according to the concept of depreciation, and these assets which are depreciable assets will be subject to depreciation, and these assets will remain as it is with no depreciation. However, when we are following our accounting practice, we also need to adapt to different accounting concepts. Now, one of the a few of the accounting concepts are prudence, then accrual. These two concepts, and there are others as well, we have to adapt to. So in adapting this, and this will lead us to decide when or if required for us to carry out any revaluation. A revaluation means reviewing the market value, of any given assets, compared to book value of the same asset, compared to the book value of the same asset. when the market value is significantly different to the book value. Now, what is the book value? There are a few other terms as well. Carrying value, book value, net book value, written down value is significantly different to the book value. Then we have to carry out revaluation. The company must have a policy. The company must have a policy, or the company should adapt to a policy how frequent they should carry out a revaluation. And if they are to revalue every year, the company should perform a revaluation on every year. So, first point, they need to decide the frequency of revaluation, whether yearly or every 2 years or every 3 years. Secondly, when they are revaluing, they have to revalue entire class of assets. Entire class of assets must be revalued. Should be revalued. Entire class of assets. It's not that, for example, if you to revalue furnitures and fittings, you have to revalue table, chair, and every categories which will fall under furnitures and fittings. If you to revalue land and building, you have to revalue the land and building available in different everything under this company. For example, if you have land, let's say in London, another land available in Manchester. So the company should, if the company to choose only to revalue the land in Manchester and not to revalue the land in London, that's not acceptable. So you got to have a policy of following an entire class of assets must be revalued. Okay, so these are some basics. Now let's focus on how the accounting works out when come to revaluation. Now, what we need to do is we need to find out, let's say we are revaluing on 1st of January, let me correct this. We are revaluing on 31st December 2017, for example. Now, before we do the revaluation, for any such assets, we need to find out the carrying value. So, what do you mean by carrying value? The cost minus accumulated depreciation and any impairment losses. You have to subtract the accumulated depreciation and any impairment losses from the cost, and that answer is the carrying value. And you have to bring the agreed market value as revalued amount. So we have to arrive this. So we are arriving this number and we are arriving this number. So let's say this is A and this is B. What we now do is we need to find out the difference B minus A. This we have a possibility that the answer may be a plus answer or a minus answer. When the answer is plus, we call them revaluation surplus. We call them revaluation surplus. When the answer is minus, we call them revaluation deficit. Or sometimes we call them impairment. So this is a way of a statement basis calculation. The same thing we can do it through T accounts on accounting ledger. How? Let's say this is my property, plant and equipment which I am planning to revalue, and let's assume I have accumulated depreciation here. So my opening balance, whatever the number I have here, and my opening balance, whatever the number I have here, and I'm carrying out the revaluation on 31st December 2017. After all accounting entries passed through required for depreciation and any other things, what you do is you close this. You have to close this and transfer this to PPE. So the first entry, this amount will be taken to here, and there you will record this, and that is coming from accumulated depreciation. After finishing this, what we now do is we arrive the closing value. The closing value, that is the value of which we are arriving with the revaluation, that we bring it here, and we balance this account, and we may have a balancing figure. Suppose this balancing figure is a surplus, we will have answer on the debit side. We will have answer on the debit side, and that should be taken to revaluation surplus account, and you will bring it down this. Suppose if you have the closing balance, what you got here is smaller than this net difference. Suppose let's say this is 100 and this is 20, and if you take it here 150 for example, so you will then have 170 minus 100, this will be 70. So that is easy, that 70 will come here. But if otherwise, in a different situation, if you think that this is 65 for example, now if this is 65, 100 minus 20 is 80, and this 65, then we will have a 15 difference. Now this 15 is known as deficit. So that deficit will be taken here as a debit. So you may either have a surplus which would have a credit in this revaluation surplus account, either have a deficit which will have a debit in the revaluation surplus account. Okay, fine. After understanding this, we then have to look into or understand the required accounting treatment according to IAS 16. So accounting treatment according to IAS 16 for revaluation. See, we may face this situation. First time revaluation, and I may have surplus, or I may have deficit. If I have a surplus on the first time revaluation, what I do is I report this in two places. One is other comprehensive income, and other one is statement of changes in equity. Whereas if it is a deficit, the first time revaluation, and if I face a deficit, I will take to profit and loss account. Now, remember, according to the IAS 1 presentation of financial statement, to present or to produce a profit and loss, a statement of profit and loss account, how this will look like? This will look like this way. A profit and loss account will have two sections: profit and loss account section and other comprehensive income section. Now this surplus must be taken to here and should be shown as revaluation surplus. Will appear here, and we will also have statement of changes in equity. Where we may have return earning column, and we may have revaluation column, and we may have total column, and also we may have other columns. So when you have this first time revaluation, we will take it here as part of a statement of changes in equity. So in the first time revaluation, you will have to report in the profit and loss account under revaluation surplus and as well in the statement of changes in equity. So that is fine. Now, if it is deficit, we will be taken to profit and loss account as an expense. So these two will be considered like income, and this will be considered as an expense. Fine. Now we need to understand if there is any possibility that we have subsequent revaluation. If we have any subsequent revaluation, what will then happen? Now follow this. Now revaluation, first time surplus or deficit, and subsequent we may have either surplus or deficit. Here again we may have deficit or surplus. Let's assume, just to keep this scenario easy, I'll write some numbers. So let me assume the surplus is 100 and the deficit also 100. And the subsequent, now we know that first time revaluation surplus, we have to take it to statement of changes in equity, and now this one, you should show it in other comprehensive income and statement of changes in equity, this 100. And subsequent revaluation, if I have a surplus, same treatment, you have to show it in other comprehensive income and statement of changes in equity. Now let's say I have 150 surplus. So no problem. Just add on this to this other comprehensive income and statement of changes in equity. Suppose the deficit of 150. Then what you do is you have to see previous revaluation. In the previous revaluation, we have a surplus of 100. So what we then do is that 100 we will write off in other comprehensive income and statement of changes in equity. So I will set it off this in both places. In the balance 50, I will take it to profit and loss account. That's when the first time surplus revaluation, subsequent there's a deficit. But now let's move on to deficit. I have a deficit of 100 on the first revaluation, which I have taken to profit and loss account, and subsequently I have a deficit of another 150. No problem, just take it to P&L. But subsequently, if the subsequent revaluation, you have a surplus of 150, what you then do is, now previously we have got a deficit of 100, so we write back to P&L as an income 100. And the balance 50, you have to show it in two places, which are other comprehensive income 50 and statement of changes in equity 50. So this is the subsequent revaluation. And one additional point here, would like to bring it on. There is a possibility that there is a requirement by IAS 16. There's a requirement by IAS 16 is that if you have an excess, if you have done a revaluation, the IAS 16 is allowing to do a transfer or an entry for excess depreciation. So what is excess depreciation is, let's say I have an asset which is the cost of asset is 1000 and lifetime is 10, 2 years is over, so that means accumulated depreciation is 200. So the net book value at the end of the second year is 800. Now I have revalued this to, let's say, 1600, for example. And the remaining life of the asset here 8. So each year depreciation, if I don't depreciate, if I don't revalue, will be 100. But with the revalued amount, my revised depreciation will be 200. Then that means now here 1600 divided by 8. You are getting 200. So that means there's a difference of 100 between the previous method depreciation and post revaluation depreciation. This is known as excess depreciation. What you then have to do is, at the statement of changes in equity situation, you have revaluation surplus and you have return earnings every year. From the revaluation surplus, whatever the balance you have, you got to transfer 100 from revaluation surplus to return earnings. The net effect in total will be 0. Thank you very much for watching this video, and I will be sharing the remaining aspect of IAS 16 in different videos. Please watch my videos, like it, do share it, and as well subscribe to benefit from many other videos to come from our YouTube channel, Global Associates.